So yes, real options theory was developed in the 70s and 80s. Basically, it is another methodology for investment under uncertainty. So previous investment methodology or like valuation methods like NPV, IRR, they do not incorporate the uncertainty element into the decision making. Here comes real options, and with the relatively simple mathematical techniques, you can, for example, you can make a model and estimate whether it's better, what's going to be a value of the option for the company to wait. They can invest this year when the conditions are uncertain, or they can sit and wait for a year, but then the conditions, or like price input conditions, or like uncertainty over input price, or uncertainty over the output price, like final price for your product, once they will be sorted, and then then you can enter a year later. So then with this valuation technique, one can evaluate the value of this option to sit and wait, for example, and see whether it's kind of like worth waiting, or kind of like it's not very valuable thing to do, so then you can go and invest straight away, or otherwise, kind of like you will see that you lose so much money if conditions turns against you, but you've entered. And this is how real option technique is normally working for the investment decisions. In my research, I was using the same reasoning, but to apply it not from the time perspective, but from the geographical perspective. So previously, we had like a company was deciding to invest either in period 1 or period 2. Conditions in period 1 are known and conditions in period 2 are unknown. I'm saying like we can use the same logic, but analyze the investment decisions in two different countries. Country A, conditions are known. Country B, conditions are unpredictable, unknown. So think of country A as like, for example, small market, but like highly politically stable country like Switzerland, and country B, large market, but highly politically unstable like Russia, for example. So, and then I develop a mathematical model to see which country will be more attractive for investors, which will be less, and under which circumstances. The general finding from the model is that this large market, high instability will always beat the small stable country. And why I'm just like considering those just two polar examples, because of course everyone understands if you have large market with good political stability, everybody wants to invest there. So like United States, for example, or if you have like crappy market with huge political instability like Afghanistan, that like nobody will want to invest there. So kind of these are those like two cases which are of more interest, which is like what will, because often when you look into the investment studies or for international expansion studies, the two major important factors which influence country selection are market size, and second one is political stability. So that's why like those like two major sort of like determinants, and in like two cases are obvious. So then let's see out of those two more interesting cases which one will be more attractive. So basically the model shows that large market, high risk will always attract investors more than like small and safe country, and basically that's because investors are greedy, and like they still will be able to reap quite a big of rewards just like even in a couple of years before the before the risk of adverse effect or adverse event will become very high. Still, like they already will be able to reap enough rewards to pay off for the risk they're taking. However, things are changing if we talk about industries which are highly capital intensive. So because their return on investment, you need to have a much longer period of time over which your investment can be recouped. So then the probability of the adverse event happening in the unstable country is much higher, and you still haven't recovered your cost. So that's why this type of investments will be normally done in the countries which are normally like small market, not necessarily small market, if you can do it in big, good for you, but kind of often this is done in countries where the political stability matters a lot, and that's why in Switzerland we'll see so many like pharma companies. That's why Intel built its subsidiary in Chile, which is also kind of it's partly cheap and highly skilled labor, but also like very stable politically country. So that's why it also seems to be a sound decision for the company.